Really good. All
Yeah,
right. Well,
you're doing the
good.
recording. That's good, John.
Yeah. All right. Well, let's get started. Okay. Thank you all for coming. We still have some people coming in, but we'll go ahead and get started. This month, this is July of 2024. We are going to continue the conversation that we started last time about the impact of debt. If you recall, we worked into this conversation coming from a lot of discussions about gross product. How do we improve the total productivity of our ranch? Debt obviously is a very important tool to at least talk about. I want to make sure we recognize and are sort of respectful of the wide variety of opinions on debt, ranging from, debt lovers to absolute debt haters. Our goal is to be, we're not trying to be central, but I think we want to recognize the fact that debt is a powerful tool that can be helpful. But we also want to make sure we talk in future discussions about the risks of debt, because it definitely does come with risks. So I want to make sure we have kind of a fairly thorough understanding of this. Today's presentation, Walter and I had a number of good follow-on discussions after last month, and Walter is going to cover similar, some similar ground, and then some new ground kind of relating to the same concept. So this is the second webinar we are doing on the impact of debt. And again, important that this is a very important topic, and important we kind of leave with a good understanding. I want to reemphasize that in our monthly meetings, if you have a question at the time, please interrupt. It's always better when people interact a little bit, especially when we're on Zoom, just to kind of get an idea of what people are understanding or not. But please feel free to interrupt and ask questions. Is that all right, Walter?
Yeah, that's great, John.
All right. So with that, let me introduce Walter again, because he has not been our presenter in a while. Walter is my mentor in all things accounting. Walter began his holistic management journey in the 90s. Walter and his family farmed in Illinois until a decade or so ago. Is that right?
That's about right. Yeah.
And then that,
2006 when my dad died. Yeah.
yep, still is a landowner there who leases out and is involved with other family operations there. Walter is the one who pioneered the adaptation of ranching for profit economics and finance into accounting software. And he deserves full credit for everything that we did when we launched this company. He sold his firm in 14.
That's right, John. January 1st.
Yeah, and it was a couple years before we started. But Walter, during my period of doing active turnaround work, was very heavily involved in that, and I learned a ton from him. And I'll just say he saved my butt on multiple occasions, and for that I am very thankful. He continues to be a really important part of our team, sort of helping us and coaching us as we work with your data. And continues to really do a lot of education work in the wider world, both in, sort of practical aspects of holistic management on the ground. And I'll say holistic as sort of a catch-all word that includes regenerative and, kind of the RFP and the understanding ag and all that. He's continued doing all of that, both on the practical side on the ground and from a financial perspective. So Walter, I am always thrilled when you will join us, and I'll let you go with that. If there's anything you want to add, please feel free.
It's an honor to be here today, John, and I hope we get to see some faces, because I love seeing the participants when we're on here, because I know that one of the pieces that I'm really pleased with is that it seems that John's demographic with Ranch Right is um, a younger group, and I think that's the key to keeping life in our small towns in America, and there's the understanding of how we tie all this together. And I'm in the camp that it's Wally's on today here too, and I think we're all on a mission to that space that is between our ears. We want to share that when we can.
The longest 6 inches, as Fred Provenza describes it. And I think if you looked at our numbers right now for the people that are here 80% of them are mid-30s or below. And so that when I go to ag meetings, that's a significant difference from the average demographic.
Right. And another piece I think that I want to share with you too, I think that, there's a time, I think there's a space of this, or there's a mindset, I guess would be a better way to say it, is that, I live in Illinois. I live in Springfield, Illinois, and grew up about 35 miles north of here. But I think it seems like the livestock rancher individuals, they seem to share better than some of the row croppers. So anyway, I guess I want to make note of that, and I think that makes a difference in the understanding, because everybody that's on here will probably share something.
Awesome.
Okay. Okay. I'm going to take the screen, John.
Have at.
Okay.
I can see your desktop.
Yeah, just wait.
Yep.
See the spreadsheet now, John?
Yep. The bottom portion.
Is that okay, John?
Mm-hmm.
Okay, wait a minute here.
Can everybody see that all right? Plenty big enough?
Yeah, yeah, I can make it bigger if we need to.
Maybe just a little. Anybody that doesn't know, I've got new glasses. I am now officially graduated to progressive lenses. So
How old are you now, John?
52.
Okay, I just wanted to ask.
I cannot use them in front of the computer, but I had no idea after I got the prescription filled that I have not seen blades of grass or leaves on trees in like a decade. And funny enough, a cowboy that worked for me a couple of years, like, you've been blind forever. I don't know what your problem is. Why is that such a surprise to you? I can now see blades of grass. It's pretty awesome.
Okay, John and I had a conversation, and you wanted to make sure we have an understanding of the debt impact on our financial statements that are being generated by John's team, and they're not there. I mean, I want to make sure that we understand that financial statement is, is your family's. It is the ranch. It's a document to talk about. It's a topic, to understand. And there's a hot button here with debt, and I want to go through, I guess, probably three different ways that are three different key points. One's the debt to asset ratio, one's the interest rate, and what's the impact of term. The length of the debt. And so what we want to do, I mean, what we will find is that on a debt to asset ratio, when we take too much risk on, there's sometimes questions, as to how that occurred. Just, I have the impact, or I have the question there, or I've made a note about context. So, I mean, it's okay for a younger person probably to have maybe a higher debt to asset ratio than somebody that is, at a different stage in his life, in the process. But you have to stay, I'm going to say, within, um, stay within the guidelines of what your bank will let you do. So, some of the old rules are 40% debt to asset. Say with Farm Credit, you would have been I'm going to say a golden borrower. But then you can sometimes have not enough, where debt can add to your return on your equity in the process. So there's, you can have too much or too little of debt. So
Walter, Walter, would you quickly define debt to asset?
Oh
Just
yeah, excuse me.
okay.
Debt to asset is it's all of the debt that you have on your balance sheet, short term, long term, and then it's you take that ratio, you take that total debt and divide it by the the assets that you have that you're operating. And I'll show you. I've got some numbers here in a second that what you can
Good.
see it.
Perfect.
Okay. All right. So, though, I mean, those are pieces that we want to. You have to bring your context in. What your I call it pillow talk. What your spouse, is comfortable with in the process, and it's wonderful to see that there's some couples on here today too. So, um, we've gone, I mean, when some of you were getting started, maybe you got some FSA loans, so you had some low interest loans out there in the process, maybe the threes, maybe the twos, whatever in the process. But we'll go through what that sensitivity would be and what's the impact on different ratios. And then of course, term, we want to make sure that we have the right length because I mean it's the length of the loan. Is it a 5-year loan? Is it an operating loan, which is short term and generally for a year, or is it something that's longer term, say 15, 20, or even 30? I think some of the FSA loans where they had the government guarantees with USDA were actually, I think there's some 40-year stuff out there.
There
So,
are.
yeah. Okay. So, do we have any questions at this point? Okay. John, do you have anything you want to add?
No, I think you're right on. Keep going.
Okay. All right. So, now this is a very high level balance sheet that we're going to do today. Okay. And
High level meaning we're just dealing with the very surface stuff. There's a lot of detail left out.
yeah, we didn't, I don't have the assets broken down into current assets, long-term assets, intermediate, cattle, whether they're market or breeding or stockers or whatever. We're working on this at say at least a 30,000 foot um, view. So, okay, let's look at total assets are $500,000. We've got 275 in debt and 225 in equity. So so what I've got is I've got a slider here. So let's I'm going to change the let's go down on let's go down to about say 45%. So, I mean, we've changed that debt to asset ratio where 45% of 500,000 is the 225 and 55% is the equity to the asset. So that comes back to the total assets. Sometimes we see where bankers talk debt to equity, but most ag bankers, it seems to me, they talk debt to asset or equity to asset. Is that what you found, John?
It is, and I'll be honest, I prefer debt to equity because I prefer to think of them, two halves of the whole. But
Right.
either way works. I mean, it's just a transition.
Yeah.
Explain to me why your equity number is negative, would you please?
Well, that's just an accounting thing.
Okay.
Okay, I'm making it come back to
you're doing that to fit the formula. I got you.
right.
Yep.
Yeah, I'm doing the debit and credit stuff.
Yep. Okay.
Okay. All right. So so the debt to equity is, I mean, I like to show debt to asset and equity to asset because they come back to the 100%.
Correct.
Okay. The equity, the debt to equity is just the debt divided by the equity. And then the financial leverage, that's the total assets divided by the total equity. And then in this scenario, I'm using 6.5%, and I've got a 10% or 10-year term. And debt coverage is something also that we want to talk about too, and I'll get into how that can change. But those are some of the key ratios that we're wanting to monitor today. Okay, and so I went with a gross product of $500,000, direct costs at 35%, overheads at 35, a respectable family living number, and then we're amortizing the debt. And let me show you the amortization because I've got an amortization here. See, there's the 225, which that's the number up. That's the number right here. So that is, I mean, we're using that all the debt right now is an amortized debt in the process. Um, so we've got a 10-year term. The annual payment is $31,298, and the interest is 6.5%. Okay. So that, I mean, that's the interest rate, that's the term, and then that's the coverage. Now, one piece that John and Wally and Daniel and the Ranch Right team, we try to look at what does debt have a positive impact on our net worth. And one of the pieces that we can show about that is if we take the average assets in this particular example, which is the 519,000, we have the liabilities are 216, and the equity is 302,000. So if you take the return on assets, which is the 13.4%, you get 29,000, and you get 40,000, or so that's the 70,000, or which is the earnings before interest that we have over here in our financial statement. But since we've got some borrowing, okay, we've got $14,000 worth of interest against that debt. So the net after the debt payments, I mean, on our money it's 40,000, and then after the debt payment, it's actually, or the interest payment, it's 14,000. So let's see what would happen. And a piece that I think that I call it, sometimes when John and I have been talking about, we like to look at an ROA, which is, there's a couple ways to look at it. You can divide the 70,000 by the average assets, or I always like to prove it. So I look at the turnover times the profit margin, which is the profit margin being the percentage of our profit before the interest, which is 14%. So it comes out about 13.48 is our return on assets. But if we want to see, if the big test is if ROE divided by ROA, if it's greater than 1, I call that the juice. Okay, and I know,
great term, my new favorite accounting term.
Yeah, I know, and you're not even Italian. Okay.
I don't know what that means.
Well, yeah, I got it. I will help you understand that, John. Okay, all right. But if you take the ROA times that juice factor, that's the ROE. Okay.
Yep.
So I mean, it's huge in the process. So what happens is how high can we're at 6.5% right here. Okay. So how high can the interest go? And it be break even on the interest. So let's figure that out.
So just to clarify, this is we've all lived here in the last few years through a significant increase in interest rates. This is
Right.
effectively a sensitivity test. What is the impact of a significant increase in the interest rate?
Right.
And I'm going to repeat my saw that interest rates are not actually high now. They're about average, maybe even a little below average.
So you can see interest has to go to 13.2. That's the break even, John.
Yep. And so let's review a little, explain ROE and ROA just a bit and what the parameters on this number are. So return on equity is
Yeah,
what is the total return based on what I own?
Correct. That's the
Right?
that's the 295.
Yeah.
So it's the 40,300 divided by the 295.
And then the return on asset is the return, the profit, if you will, divided by the total assets under control, whether they're
Well,
financed.
yeah, but the ROA is before the interest.
Correct.
Right.
And
you're dividing that by the assets.
Yeah, and when that ratio is 1, that means those two numbers are equal.
Correct.
Which means that I am neither being helped nor hurt by the additional debt, correct?
Right. But as you can see, as we lower interest,
it goes up.
goes up.
Yep. Does that make sense to everybody? How that's going to behave?
And see our our profit over here is going up too.
As interest goes down.
Right.
You're on term now, right?
Well, excuse me. Yeah. Whoop. Sorry. Yeah. As interest goes down, that goes up.
So at 13.5% interest, this business basically doesn't really have any business borrowing money, right? The borrowing money is having no positive impact.
Yeah, it's nominal. I mean, so I mean, what you're really looking at is, I mean, one piece I could do is of the profit, I could put a percent in here of the profit that's actually coming from the debt.
Which is what we did last time.
Right.
Right.
Right. So, so a big picture. Do this on the fly here.
I have vowed to myself I will never do spreadsheet alterations during a presentation anymore. I lock myself out now the day of. I still make mistakes. Helmick, I'm going to mute you. I hope that's all right. Sounds like you're wrestling alligators down there.
So you can see 7%. Whoop. Come on here. Yeah. 7.7% of the profit is actually coming from other people's money.
And so that would be 7% of the 43,760 or 675, which
right.
Is so the debt at what are you at? You're at 11.7% interest rate right now.
Right.
In this business, that means that the business made an extra $3,354 after interest.
Right. So now let's go ahead and lower this down a little bit.
How many of you want an 11.5% interest rate? Yeah, right.
Now, I mean,
You
this is
could do it.
probably something that's in the realm probably right now.
See lots of this, even up to 9.
Right, right. But I mean, even at the 8.5, you're making a margin on that debt, and it's 20%.
So debt after interest is costing you, or is earning you $10,000.
Right,
Okay. Does everybody understand that? So, 1/5 of the profit of this business is coming because there is leverage.
yeah. It's coming from other people's money, OPM.
Yeah.
Okay.
This is a place I think we want to think carefully when we look at the dollar amounts and the juice number. Just because adding debt is positive in this type of calculation doesn't mean it's a good idea. I think there is a margin there that, and again, next time we're going to talk more about risk, but there is a margin there that we want to make sure we add I want to add a significant amount with debt to overcome any added risk. Is that fair?
That's correct. So I mean, is 20% the right number? That's the question.
We'll see.
Yeah.
Yeah. Depends
Right.
on the business.
Yeah, it depends on the business and your context.
And I would look at that as a percent and the dollar number, because we might be able to debate the 20%, but 10,000 might put us in a more concrete sort of debate about what is the dollar value of the risk I'm taking and what is the dollar value of the potential benefit.
Right. Right.
Are you making more money on their money or your
And
money?
coverage play into that as well.
Yeah, I'll come back to debt coverage in a minute.
There was another question. I didn't quite hear it. Kevin, was that you?
Yes, sir. Are you making more money on their money or your money in this scenario, like percentage wise?
Well, I mean, big picture, you got $50,000. That's the net income here. Got it?
Yes, sir.
Okay. So, and 20% of that is the 10,000, and the 80% of it is the 40,000. Okay, because you've got $29,000. That is the return on the debt. Okay, but you've got $19,000 worth of cost against it.
Yes, sir.
Okay, does that help you, Kevin?
Still not understanding.
Good.
So I guess my question is, how do you know whether to like basically borrow more money versus and then like have more cash in the bank for emergencies versus using your own money versus their money?
Well, that's what John's getting at, is that, I mean, the piece of it is that if you run that down to say, well, I mean, if you ran that down, let's say we run it down to 10, we're going to increase the rate to bring it down. Okay, just for. Well, see right there, that's probably you wouldn't want to do that. And see, another piece of it that we're doing is your debt coverage over here. Actually, it's not bad, but we like to see that in the closer to 2. I mean, is that what you like to see, John?
Yeah, we're wandering down into territory that we better have a reason why it's that low.
Right.
So if we've just taken on a new long-term debt and it's dropped there, I'm okay. But 2 is much more where we want to be. Kevin, I want to follow up on this just a little. So your question initially was, are you making more money on your money or their money? Did
Yes,
I
sir.
understand right? Okay,
Yes,
so
percentage-wise.
in this particular case, you are making more money on more total dollars on your own money. Now the percentage is the same, right? But when we add the cost of interest in, that you are actually, the significant amount of your profit is coming from your own money. Now,
Right.
the debt
and
is still positive. It's just relatively small.
The borrowing is actually adding 23% to your profit.
Correct.
Does that make sense? Yeah.
Yes,
Okay.
but like, so how do you determine like whether to like take and like pool cash versus taking that cash and having less debt? Like, how do you determine what that breakover is?
Well, I mean, where that comes, I mean, it's an individual. I mean,
There's no rule.
right.
You
That's
have to
exact.
decide.
I
So
guess.
remember the last point in his other spreadsheet about your context matters. So some of your context is literally what is your preference and taste and risk tolerance.
I mean, one of the pieces here too, Kevin, is that John and I for this, we didn't do working capital. So, I mean, you would need to look at your working capital position if you went ahead and paid some of the longer term debt down. Okay. And we're not doing that in this particular deal. So, I mean, I think John, you try to coach your clients that somewhere 3 to 6 months is a number that you try to want to make sure that they have working capital for that. Okay. And so if you drop back, Gavin, to say 2 months, that's not a good situation.
That makes sense. Yes, sir.
Does that help you now?
Okay, and let's add a little more color to that, Walter, because even when we look at that debt coverage number, if we have a great working capital number and an okay debt coverage, I'm fairly comfortable. If we have a very bad working capital and a weak debt coverage, to my mind, that's an opportunity to get into trouble, right?
That's correct.
Yeah. So there, again, there are a lot of these things, and this is greatly simplified, but I think it covers the lion's share. And really, when we talk about debt, we can give you some guidelines, but again, we also want to understand what is the underlying situation, because if this was a very high risk type situation, maybe 10,000 isn't enough. What is the potential gain compared to what is the potential loss? Those are some simple numbers I like to start with. I see situations all the time where we risk $100 with the chance of making $1, and others where we risk $1 with the chance of making 100. That second one, you don't have to do too much math on it to figure it out.
Sure.
The first one is the same way. We don't have to do too much math. The problem is all the middle cases. It's like, yeah, it might be better, it might not. If I could increase the profitability of my current operation by 20% with additional debt, I'm going to look at that. Like, that's in the range of, this is interesting. Does that make sense?
Yeah,
Sure.
I mean, what you're saying, I mean, and that's your own. I mean, number one, I like, John, that you're looking at a dollar amount of it versus a percent, because you got to put them both together.
Right.
Because I mean, like on, say, liquidity type issues, you can have a 3-to-1 current ratio. I mean, current assets divided by current liabilities, but you may only have
$7.
Yeah, $1,000 of working capital. Now, $1,000 of working capital on a ranch or farm of any size is nothing.
Yep.
Okay?
Well, keep going. Sorry.
No. Go ahead, John.
Okay. Let me jump in real quickly. There was a question about ROE versus ROA. Danny, I think this is you. The difference between ROE and equity versus the assets is not the interest, it is the liabilities. So there's a question in the chat. What's the difference between ROE and ROA?
Yeah, the ROE is based on, say, the 300,000, the way it is set right now, where ROA is based off of the 517.
Does that make sense, Danny?
I see the 517 over here, column H in the balance sheet. What was the other number?
Up here,
324.
517 is the total assets. And then got it. Okay.
Yeah.
Does that make sense, Danny? because
So the
you're looking
difference
at,
is the liabilities.
yeah, the
Okay.
difference is the 299 is is your money, your money.
The
What kind of rate of
The
return?
217 difference is how much you've borrowed.
Right.
Yes.
Okay.
So what you've borrowed is showing up in your assets.
Right. Right. Yeah. Because if you, yeah, because your total assets are 517 and your total liabilities are 217. So you got 300 left.
Now, here's an important thing. When some of you have heard me talk about, stale and toxic debt in the past. One of the reasons that type of debt is such a problem is because it increases indebtedness without adding to your asset value. Okay,
Right.
so there are times, ideally, we are borrowing money and increasing our asset value. But for example, when you term out a line of credit and convert that to long-term debt, there is no increase in the asset value. There is only an increase in the liability.
Right.
And so that's why we get really hard on that type of stuff, because that, effectively you've added cost, you've added risk, you've decreased cash flow, and you haven't increased your ability to service the debt you had even prior to that.
And let's go there, John, on that whole deal. Okay. Let's move the term debt. Let's say that you got somebody that's somewhat of a novice and they go into the bank and they don't quite understand their payment in the process, and this 225,000, the banker says, well, we're going to set that up on a 5-year deal. Okay, so what's the impact of that in the process? So let's go and see what happens. Okay, so let me go a little bit.
Three.
Let me go a little bit shorter because I want to make a point. So they set it up on a 4-year deal. Okay, now what's happened here? Okay, you've only got $550 that your assets are increasing. Okay, that's not good. Okay, so they set it up too short, and you've only got $1. I mean, you're making a $49,000 principal payment, so you've got a coverage ratio of 1. Where John, I mean, what we like to see is closer to 2. I'm not saying it always comes out at 2, but you definitely want it. You want it greater than 1.5. Is that a fair number, John?
Yep. And again, remember, that means that one here means that every dollar of your profitability goes to debt service.
Right. And here, let me show you the
Heaven forbid that thing bobbles just a little.
Right. So here's the cash flow. Okay. Here's the net income, and here's the principal on the amortization. So we've only got a change in cash of $550. That's not good. Okay.
How many of you want to work all year for an extra $550 like that?
Good question. Right.
And it's literally just the 550. That's all that it is.
Right.
Not enough to make it worth.
Right. So this piece of having the right term and having that structure, I mean, let's go and come on here, Walter. I mean, if you've got the right kind of borrowing base, you can see that what happens to the debt coverage ratio. I mean, but let's kind of bring the interest rate down a little bit. Okay. Whoop. So, I mean, you're getting an ROE of 17%. I think that beats a lot of mutual funds. And 22% of your profit is from somebody else's money. You're making 29. Your juice number is 1.3, which is I think respectable. So I mean, what we're trying to do is look at. I mean, if this gets way well, I mean, getting back to I think Gavin's question. Let's say we go and we run this up to 20. I mean, let's say that it was 20. Now you got a debt coverage of 3. What's it take? I mean, you've probably got a very strong working capital position in that process. And maybe it's okay to go ahead and pay some debt down. But there was forethought on the front end of the structure of the debt. That's what I'm trying to say. Does that make sense, John?
Yeah, let me add to that just a little. I'm seeing it less now, but a couple years ago it became rampant. Please do not allow your banker to inappropriately finance things. I know you can go and buy long-term assets with your line of credit. Please don't do it. It will
Right.
will bite you, because if you get in any kind of trouble, the idea with a line of credit is that if you're buying an asset, it is a short-term asset and it will turn back into cash fairly quickly. If you go and buy a bunch of pipe to build corrals, or you buy building materials to build a barn, and you finance that with your line of credit, and then something happens, you have a problem. And of course, a couple of years ago, something happening meant that interest rates doubles and everybody's bank got super nervous and nobody would do anything. Well, now you have to pay back that line of credit with no, sort of asset that you can reasonably sell in the time period allotted without incurring additional cost. So don't finance things for too long, and definitely don't finance things for too short. If anything, I would rather err on the long side than the short side, but you can do it wrong both directions. I don't want a 20-year term on a minivan, as an example, and I don't want a 1-year term on building materials.
Right. Well, I mean, and then when you go back to the bud marketing piece, there was a balance between cash,
Yep.
livestock, and what your feed is. And so, I mean, we're trying to make sure that we're trying to make sure that we watch that and how we do our structure.
Yep. One other thing that comes up a lot, and there are a couple of questions in the chat I want to get to too, Walter, but
Go ahead.
Let me mention this first. I am very, very cash flow focused when it comes to debt. And so most of us are interest rate focused. I am often much more focused on the terms. And
Right.
there
And that's what I'm trying to get at with this,
yeah, you're doing this is a perfect illustration of that. Especially when we look, you mentioned, sort of paying down working capital and relieving yourself of long-term debt. When we do that, please do not do that with a focus on the balance, the principal balance or the interest rate. Do that with an eye strictly on the impact on cash flow. So if I have $1 million mortgage and I can pay down 900,000 of that, it literally has no positive effect on the next year's cash flow if I do that, unless I refinance it down to $100,000 mortgage. Whereas if I have even a low interest loan that has a very large payment, and some of our like tractor and machinery payments will have this, right, where it's a 3-year note, it has a very high payment, which means it has a very negative impact on your cash flow. I'm going to be much more focused on clearing the whole thing so that I no longer have the payment. It's very much like Dave Ramsey's debt snowball deal. It's a little different focus, but improving your cash flow is the most important thing you can do when relieving yourself of debt.
Because you want to stay in the game.
Correct.
Yeah,
all right. With that, couple questions. Helmick about juice. I hope I got that answered. Taylor asked about definition of debt coverage. So Taylor, we have, I think, 1 or 2 webinars on this.
Well, okay.
Go ahead. You're going to get
Let's,
into this?
yeah, just a second. I'll show you. Okay, Taylor, if you look at the 52 here, okay, if you look at what we're doing is see the earnings before interest right here, which is 70,000. You'll be dividing that by the 33.5, which is the payment. So that's the 2.09, 2.1% or 2.1 times, not percent. It's, because what it means is that there's over $2 for every, there's $2 of earnings for every $1 of payment.
And this gives us, we've talked about this a few times. I did a ranching for profit continuing ed on this topic. This again, debt is serviced with with profit. Okay. Debt is not an expense. It's not an overhead. It is effectively an after tax payment. We have to have enough profit there post tax in order to be able to make that payment.
Right.
So we want to roll that out and make sure we have, not only room for something to go wrong, but room for the other things that have to happen, like paying taxes. But we want to build comfort in there. We never want to plan for a 1-to-1 because again, if anything goes wrong, then we literally can't make the payment. I have talked before and done a couple of public presentations about businesses that are profitable and yet fail because they don't have enough profit to cover their debt payments, and that would be a debt coverage ratio of less than 1. But it even can be slightly more than 1 if you include other things in there.
Let me come back to Aaron's.
Explain it. Does that explain it?
Oh, excuse me,
Taylor? Does that help?
Yeah. Yep, that's
Okay.
perfect. I just had it mixed up with another definition and the numbers weren't making sense.
Yeah, correct.
Okay, back to Aaron's question. If you take ROA times the juice, that's the ROE. Does that clarify that, John?
Yep.
Okay.
And then again, last month we talked about the number that we are calling debt impact, which is a little different than the impact of debt, but that's this number that Walter's got over here on the right-hand side in column L, which is how much of your profits are actually coming from having debt. So in this scenario, as it stands in column L, we have 22% of our profit is coming from borrowing.
All right.
Does that make sense, Aaron?
Yeah.
John, how would you know that? Like, how would you know that your profit is coming from debt?
Well, that's why we went through this. That's why we went through this analysis here.
Okay.
So
Okay.
maybe walk through that one more time, Walter. It's a good question.
All right. Okay. If you take, okay, I'm gonna highlight that just for a second. Okay. All right. So if you take, we've got. Let me make a comment here. Let's see here. Okay. Just to clarify this, so that you can. I didn't have that labeled. Okay. So if you look at the debt, it's the 217, right? So that's our starting point. And then so what we're trying to do is to come back to what, I mean, we've either our assets, we either own them all or we've got 45% of them, or 42% of them in this case are, they're actually, you got a partner, the bank. Okay. So then you take the ROA, which is the 13.5 times the 217 and the 301. So it's the 29 and the 40,000. And then the interest, is the 8%. And so that's the 18,000. So you've got $29,000 of return that was from somebody else's contribution to your business, but you had to pay them interest. So you're making $11,000 on that $18,000 number.
Does that make sense, Danny?
Yeah, it does. Basically, you're figuring out what you're taking your assets and figuring out what your profit is, but then you're taking out how much of that came due to debt.
Correct.
Absolutely.
We're breaking it down because see, Danny, this is the 52 right here. And then this is the bottom line. So all we're doing is we're breaking that component. We're breaking it down.
Yeah. Okay, thank you.
In a different world, instead of that being debt, sometimes that is, you know, shareholder equity. And so again, what is equity A making versus equity B, et cetera. And we don't need to go into that, but there are different ways to sort of figure out we have X dollars of profit. Where is it coming from?
Right.
Now, there are also some places, don't take this overly literally, because there are some places where, for example, you have the debt and, you know, the debt is the only thing that allows the business to go forward at some meaningful level. So that's, I don't want to get super dogmatic about this, especially, you know, out at the extremes. But in general, I think this is what is that fair, Walter? I mean, there are places where it's like, look, the business can't get out of the blocks if it doesn't have debt. And I'm not saying that's always the case either, but there are situations where you can't do that. So we can argue that the debt makes X amount of money. Well, it's really the total cash pile, or, you know, the total asset pile that makes it.
Okay. So we've looked at the debt to asset ratio, which is our leverage. So I mean, you can see
Walter, we dropped the debt to asset ratio. Let's increase it to an extreme, if that's all right.
Okay, got it.
So again, debt to asset is how much is your money, how much is someone else's money. We are at a period where the market is high. To my mind, having a high percentage of someone else's money in our business right now creates risk. Creates risk at any time, but I think it creates more risk, an outsized risk right now compared to, let's say, 3 years ago.
All right.
So now what's your debt to equity now? Yes.
Yeah, your debt to assets 75 and your debt to equity is 3.
Okay. So debt to equity means now that I have 3 times, there are 3 units in this. I've got 3 times as much other people's money in as my own.
Right. Right.
I am heavily leveraged here.
That's correct.
Okay. Now that means that the contribution of that debt to my total income is higher.
Yeah, you're 50-50.
Correct. But risk says that isn't necessarily better.
Right. Right.
Does everybody understand that?
Yep. Because now you're getting into that sleep at night type process.
If we have, you know, if we went and bought, so I saw some cows sell for $4,200. If we went and bought a bunch of $4,200 cows and financed, let's just call them $4,000 cows, and financed them at 75% debt, that I would be in those cows $3,000 of debt. If it doesn't take much of a market move to get me in a bad spot. Is that fair? Okay. Whereas if I have $3,000 cows that are financed at 50%, I can weather a lot more market variation without being kind of underwater on those cows.
And then, I mean, this is at an 8%. interest rate too, John, also.
One of the interesting things that's happened the last few years that has really impacted people's operating costs and their operations in total is the fact that, especially for stocker operators, we have seen simultaneously a doubling in price of the stocker cattle. So if you're buying calves to put out on grass, those are basically, 50 to 100% more expensive than they were a couple years ago. And the cost of interest has doubled. And so the cost of interest doubling is one thing. The cost of the calf doubling is another thing. And when you add them together happening, kind of in real time in lockstep, it had a pretty significant impact on people's cash flow.
But see, but one of the pieces here, I mean, we had that at 2. So I mean,
Yes.
that's the risk piece that we've
Correct.
made so I mean we've got a whatever, almost a 28% ROE, but the bank's going to be a little squishy if the debt coverage is only at 1.2.
Yeah, I don't think you're not gonna get financed with farm credit at like 1.25.
No, right, yeah, or FSA, right, yeah, that definitely farm credit, yeah, right.
Yeah, but you're right. That is kind of where the risk shows up. Now, your ability to make that payment is
Well, I mean, let's
problematic.
cut that back to 5. Yeah,
Now
that's not pretty.
Yeah. Does
Okay.
everybody get that?
Walter, can you go the other way? Can you put the term debt back and then cut the interest rate until your debt coverage goes to 2, just to mimic, what we used to see, or in my young age, what I used to see at low interest rates when people would get highly leveraged.
Yeah, wait. Well, what's the number you would like for me to shoot at on debt to asset?
Oh no, I wanted you to drop the interest rate until the
Oh,
debt
okay.
coverage. Yeah.
Okay, wait a minute.
I don't know that it gets there.
Might not.
It's going to get to about 6.5. It'll probably get whoop, come on there. Yeah, let's go back up a little bit. There's at 1.5, at 5.5. But then here, let's go with, I'm going to take this down. Yeah. So you gotta do, so you gotta drop it some more to actually get it. Whoop.
For 1.5.
Yeah. Whoop.
Now you're going.
Yeah.
You got to keep going.
Right. Yeah, there you go. Yeah. So 4.5,
Does that answer what you were looking for, Taylor?
Yeah.
Yeah. So 74% debt to asset. And, I mean, you've got a 34% return. I mean, that's positive, but you better be talking to the banker frequently.
Because you're right on the bubble.
Right.
Hey, John, I've got a couple questions.
You bet.
Go ahead.
Are y'all talking more about like equipment debt than farm debt, or how does the idea of, purchasing farmland, how does that affect these ratios? And then to follow up with that, at FSA, we see a lot of like really long debt terms, like all the way up to 40 years.
Right.
And that significantly increases the cash flow. But I do see a lot of people talk negatively about that, like because you'll be paying so much more interest over time. Do you ever advocate for shorter terms just to pay less interest over time, even if that significantly decreases your cash flow?
Boy, I don't, but you know, we want to be reasonable there. Like I used an example earlier of I had a wonderful friend once that bought a 5-year-old Chrysler Caravan, Dodge Caravan, used minivan with 100,000 miles and got a 6-year loan on it. I think that's a terrible idea. But this was a while back when the Dodge Caravan was a disaster, anyway. But I'm super cash flow focused. So if I can push that thing forward and have terms that do not have a penalty for prepayment, I feel like I can manage the interest reasonably well. If I'm willing to do prepayments, as long as I have cash flow, but I really hate to restrict the cash flow too much.
Well,
Like,
I mean,
there are boundaries to that.
yeah, I mean, I think what you really have to look at is that current asset, the working capital piece. I mean, a young operator, their constraint is typically working capital. So whatever you can do, the terms of what the FSA is offering actually help you to build that working capital, I think is probably something you really gotta understand how this all fits together. Would you agree with that, John?
Yeah, and the ability to build that working capital is also what builds your ability to service debt.
Right.
Right. So those two things are heavily correlated. Does that answer your question, Michaela?
It does. That's kind of, I've always liked the longer terms just because of the flexibility.
Right.
Yes.
Um,
An
and then,
FSA doesn't usually have a penalty for early payment, correct?
no, we would never penalize that, but we do have some policies now that they actually want the debt coverage ratio to be lower. And if you have a debt coverage ratio that's too high, they will reduce the term on your debt. Like
Right.
they take it down by 5 years, like until you get to a pretty low debt coverage. Um, I'm pretty sure right now it's like 1.25. They want you to go.
Yeah, yeah.
I'm assuming that's because they're encouraging you to go to a different lender.
That's right. Yeah.
They want you to go to somebody else.
Right.
They don't want to compete with the lenders.
Correct.
And then just so I understand, is this like that when you're looking at assets and liabilities and equity here, if we were wanting to do like a sensitivity test on our own operation, would it be better to exclude land assets, land debt, or because, like the whole ranching for profit philosophy of land being more of a personal investment rather than like an actual business investment, is it better to exclude that from these numbers, or would you do this based on like all of your assets and all of your debt?
Okay. Michaela, John and we have this chat frequently, right, John?
We do.
And Michaela, we would probably say to look at the land, I mean, what they're telling you to do is fine. Because what you're really trying to do is what's this ROA here? What's this ROE based on the average assets? Because you have an opportunity with good management, you're going to beat mutual funds. You're going to beat them, but there's a drag with that land piece in there.
Right.
So, I mean, I think John, we would still probably put an opportunity cost in there for the rent we wouldn't exclude that.
Right. But I've realized that I take a blended approach to this because I use the operating company ROE, ROA.
Right.
But then when I calculate debt coverage, I usually include the factor of a mortgage payment in there.
Right.
Because ultimately the operating company is usually the biggest contributor to the mortgage payment. So whether we do that with an opportunity rent type cost or not, we still have to have enough money at the end to make the payment. Now,
Right.
if the operating company is not a significant contributor to the payment, you could leave it off. But I feel like the blend I try to take is I don't I don't want to penalize our ROA with a, multi-million-dollar asset plunked in the middle that has fairly low return. But I want to make sure that I actually can make the payment comfortably.
That makes perfect sense.
Yeah.
It makes
Yeah.
perfect sense, but it also kind of violates every rule in the deal too, right?
Well, the ratios don't mean anything if they're all skewed to the point of looking terrible.
Right. And again, we've talked about this before, right? The ROA expectation for land is very different than for my operating company. So if I have an operating company that's worth $500,000 and it generates a 40% return, and I have $5 million in land that generates 3%, that's a weird average to figure. So I'd rather just deal with those separately. But I have to make the mortgage payment.
Thank you.
Thank you. That's a great question.
Yeah. No, thank you, Michaela.
Can I
All right.
ask what y'all mean when you say leveraged? I'm sorry, we missed the first one, so we may just be really late to the game, but y'all said you're heavily leveraged.
Okay, leveraged and debt are, and I would say leveraged and indebted are probably similar. So leverage is that proportion number. Heavily leveraged means you basically have a lot of debt. But the debt is always scaled in proportion to the asset. And here's another important point I think that we need to talk about, especially when people are very anti-debt. Whenever we talk about debt, we should always talk about it within the context of the asset, because everyone I know that likes to complain about their mortgage has a nice ranch that they live on. And so and if you have debt on a set of cows, you don't just have debt, you have debt and you have a set of cows. So we sometimes get very fixated just on the debt side. Let's make sure we know what we're buying. Now, if we have toxic or stale debt, right, that is debt on something that is not doing anything for us. That's a different situation. But as long as we're in the realm of the possibility of good debt, make sure we're including both sides when we think about it. Because it's easy to complain about the payments, and it's sometimes hard to appreciate the asset that goes with it. Other questions, other thoughts? Good discussion today.
Yeah,
guys.
this is good. I mean, this is one of those things that when you sit back and you reflect about what this spreadsheet, says or can help you to understand. It helps you to understand because you can get into the context piece of it, and does what's going with that, do the numbers, are they aligned with your context of what your expectations are? And so it's huge that I feel blessed I get to share this with, because I don't want the participants that's on here to spend 20 years figuring this out. And I think that's something that John and I truly believe in.
Walter, can you walk through everything in your DuPont identity box, including what DuPont identity is?
Yes, I can. This is just a quick and dirty ROE methodology that I found. So what you're doing is you're taking the net income percentage, okay, which is the 1175 times the turnover ratio, which turnover is your gross product divided by your assets. So it's 96%. And then this is a leverage computation, which is total asset. It's kind of the reciprocal. It's related. It's kind of a reciprocal of the debt to equity. And when you multiply those together, it's 19.3. So it's just a quick and dirty way. It's really focusing in on, what things can I change? Because let's go back up here just a second. Let's say that, John, I've got family living in there. You want to drop the overheads the overheads, you want me to increase them, to 40?
Sure.
You can see what happens there. Okay. Because that net income piece, because I mean, I think, John, you're trying to get your clients to actually think about, you're trying to get them to think about, that bottom line return.
Correct. And this is one where you've used these numbers as an example, but you know, depending on the type of business, those numbers could easily be reversed, right?
Right.
And I'm not going to say one or the other is good until we look at the bottom line. So
Right.
at one point there were benchmarks about where your direct cost should be as a function of your overheads. And I find that ridiculous because, well, what if I have a high direct cost business that has very low overheads and I'm more profitable? Well,
Right.
ultimately, I want to be more profitable. So that's
Yeah.
what we really care about. But this gets at two important points. One, we want to get those things within the realm of reasonable and, you know, at least, and we can maybe can even do better than that. But then we also ultimately are looking at the bottom. So you can get to the bottom different ways. There are different opportunities, different parts of the country, different types of businesses. You know, maybe you're stuck with some high overheads. Well, that's okay, because there may be other ways for you to increase the total at the bottom.
Right. Yeah, because I mean, and that's what we're trying to get at, is that there's different combinations that are going to get you in that 10 to 15% range. I mean, that's probably the target that we should be trying to get to.
I think you're low, but I'm gonna say 10 is too low.
Well,
think
I would agree.
15,
Yeah.
15 is my low.
Right. Right.
But again, there's a lot of personal, you know, a lot of personal taste in there. So maybe 20 years from now, I will be more interested in a lower rate because maybe that is accompanied by a lot less risk. Okay, so Kevin and Aaron, I'll get to your question before we wrap up. Please remind me if I don't. Kevin asked about defining turnover from the DuPont identity. So turnover there.
Yeah, it's the same as we've computed up here, and it's basically the 500,000 or the 520,000. We're doing 500 divided by 520, Kevin.
So
Okay.
500 is the gross product and 520 is the underlying asset, right?
Correct.
Okay. Kevin, does that answer your question?
Because I'm doing it off of average assets.
With
Yeah.
assets divided by
Yeah,
what?
yeah. Just take. Yeah, what you're doing is dividing the B14. Okay, you're dividing the 500 by the 520.
The gross product divided by the assets.
Right.
This product divided by assets. Sorry, I had to
Right.
That's all right.
That's fine.
It's a good question. Really good question. There are different ways to calculate turnover. Walter, is that fair? Even in the world of accounting, turnover is a pretty nebulous concept that is very definition dependent.
Right. Well, yeah, there's different turnovers. There's turnovers of accounts receivable. There's turnovers of accounts payable. There's turnovers of inventory, etc. But I mean, this one is more of an total asset turnover is what you're trying to get at.
And it's not how many times you trade them or anything like that. So that would be more of an inventory type turnover.
Right.
This is how many dollars are you generating with your dollars of assets?
And then another piece of it that you have to think about is, I mean, if you're, and I mean, there's slow turnover with a purebred operation, so you've got to think through that versus a sheep operation.
But literally those two things in the metric you're using, they could have the same turnover number, even though you've dealt with 3 to 6 individuals in the sheep enterprise and you've dealt with one or 3 individuals in the seed stock enterprise.
Right.
So when people talk a high turnover operation, they're often talking, about the animal turnover. Well, where we're talking about it is
Is the
literally
dollars.
dollars. It's all
Right.
down to the dollars.
Yeah. Because the dollar, the takeaway is the profit margin, which is that 14% times the turnover gives you the ROA. Those are the drivers for ROA. That's huge.
So what does that mean? I can get a good ROA by having a really big profit margin, or I could have a lot of turnover, or I could have both.
Right.
But if I have low turnover and low ROA, I'm going to struggle.
Correct. So I mean, so Walmart turns their inventory once a week or whatever.
And they don't make very much.
Right.
But it's fast.
Right.
Whereas and this is where when we talk, and I love this example because it's extreme, right? Pick a dairy on one side and put a birth to table direct to consumer business on the other side, right? One has checks are coming in every 2 weeks. One has a check coming in every, let's say, 3 years. There's a big difference in how we want to think about those businesses.
Well, yeah, because really what you're doing there is what's the cash turnover?
Correct.
The cash sales.
Yep.
Okay.
All right. Any other questions, Walter? Is there more you want to talk about? This is really
it's been awesome to work through this. So I mean, what we've done here, just to recap, we showed the impact of the debt to asset ratio. We went from 40 to almost 80. We showed the impact of what that interest could go to, and where there was no margin from the debt. And then we also looked at the term of the debt also, because that has an impact on. We're looking at Michaela I had a really good question there about the debt coverage, et cetera. So anyway, I appreciate the questions today and the whole process.
really good. And quickly, Derek Jackson in the chat asked the assets and the gross product are both 500,000. That's a coincidence.
Yeah, that's right. Yeah, that's
they're not the same thing. So yeah,
they're just a coincidence. Correct.
Yep. Cool. Any other questions? Great job, Walter. Thank you.
Hey, no problem.
This as we started with, these are, debt is often an important part of our business, and it is it is a part that requires great understanding. And so we have chosen to focus on this for a while because again, it's important and it has the ability to help us and hurt us. We are surrounded by a tremendous amount of negative information about debt. And every meeting I go to, there is I would say the overwhelming majority of people would absolutely prefer to be 100% debt free. It's been fascinating. I've been reading some stuff about the history of debt, and it's fascinating to me that, debt starting from the Bible forward, through, Puritan times has been talked about, very badly and seen as something that is just, inherently evil. I don't know if that's actually correct. We can debate that, but again, it is often part of our business. So whether we're just starting out or whether we've been in business a long time, I think if it is a tool you're going to use, you better know something about the tool. Aaron asked about the use of this spreadsheet. Somebody else did too. So we are going to make this spreadsheet available on our website after I get the final version from Walter. We do not, sort of as a matter of course, plug your monthly numbers into these, but in our annual summaries, we are covering a lot of these same numbers as you've seen from prior presentations. This is one, if you would like to work through this with us, I would be more than happy to do that. You and your staff accountant can work through that. You and I can work through that, however you want to do it. But these are numbers that, you know, the numbers Walter has here come straight off your financials. There's really no playing around here other than the formulas that he's added. But the input numbers, assets, liabilities, and equity all come straight off your, and the net income all come straight off your financial statements. Okay, great. Walter, this is always fun. I'm thrilled to do this. Thank you all for joining us. I really appreciate it. I hope we've got a few things going on here that we are going to talk more about in our next meeting. Those of you that are FYI subscribers, I would ask you to please pay attention to your email. You will be receiving some notifications shortly, and stay tuned for more on that. If you have not already heard, we haven't officially announced it yet to everyone, but it is coming here very quickly. Ranch Right is starting the Ranchonomics podcast. The first couple of interviews are actually live on Apple and Spotify and all. I'd love to get feedback from you guys on those things. Similar to here, we're doing something, you know, we're staying in the realm of business management and finance, and trying to cover topics to help people understand their financials better. So if you have topics you would like us to cover on this webinar or on that podcast, I would love to hear about it. There will be some overlap between the two. As you've probably seen, this program is very focused strictly on the financials. The podcast will be a little more focused on how the operation of your enterprises interface with the financials. So it'll be a little more back and forth there. But Ranchonomics, like I say, there are 3 or 4 episodes already out and more coming. So look forward to seeing you all there. Thank you very much for being here today.
Have a great evening and rest of the day. I'm glad I could be here today.
Thank you, Walter. I really appreciate it.
No problem, John. Be great.
Okay, bye.
Thank you, Walter. Thank you, John.